Today we have with us Mr. Anish Teli, and I'll start off by introducing him. So Anish has been a successful investor in Indian equity market for over 15 years. He currently is managing partner and fund manager at QED Capital, which is a quantitative system-driven PMS firm. He has worked in senior position with private equity funds managed by ICICI Venture and Morgan Stanley Private Equity Asia for over 10 years. In 2011, Anish became an independent investor and focused on listed Indian equity markets. He also conducted research and developed quantitative trading systems and has been using them successfully since 2012. Anish is a rank holding chartered accountant and a PGP from the class of 2004 at ISB. Anish, over to you.
Thanks, Anand. Thanks for that introduction, and thank you for inviting me today. It's really a pleasure and honor coming and talking back to the alumni group and the current class. So we want to keep this interactive. So at any point in time, you guys have any questions or you want to have any observations, just feel free to type something in the chat box. And so what the way we're going to do this is I'll just going to give you a little bit of background about myself and how I started my life as a fundamental investor and how I got into quantitative investing, and then my journey along the way as I found out how it could add to my the tools that I already had in my arsenal as a fundamental investor, but how I could, as a quantitative investor, I could capture all of that knowledge, but still do it in a system-based, rule-based way, and not in a discretionary manner. So with that, I'm just going to share the screen with you guys. Yeah. So this is what I said. This is what we're going to talk along the way. Let's jump into it. So this is like Anand mentioned, in 2013 I got into quantitative investing, and after my private equity stint of almost over a decade, as I started investing in the liquid markets, the public markets, I felt there was something missing in my arsenal, or something missing in my framework, which did not tell me how to sell. I knew how to buy. The stocks I bought were pretty good and they performed well, but over a period of time, the portfolio was doing okay. It was not doing great compared to what I thought it should do. So what I did in 2013, I sort of took out all my old the last 3-4 years investments that I had made, and I started examining all of them. And along the way, I was also, I had been exposed to a lot of literature from and books, prominent among them being the Market Wizard series by Jack Schwager, and almost every other person featured in that book spoke about the importance of a stop loss. And when I did that study, that's when there was an epiphany. So what I did was I looked at my portfolio, and these were the losers, and I saw that what would happen if I put just a 10% stop loss in the stocks that were going down, and what would happen to the return. And if I sold them at almost a 40% loss, and if I had continued holding them on, I would have made a 62% loss on the loser portfolio. The winner portfolio was doing well. The winners take care of themselves. You don't really have to worry about exiting, and once it's gone on a trajectory, but neither do we sell our losers very fast. And that was the one thing that I was missing. Now, when I did that exercise, I found that my actual portfolio return was about 18%. Had I put in the stop loss at just a stop loss of 10%, my portfolio return jumped to 33% almost. And had I not exited even when I had to, my portfolio return would have dropped to 6.8%. So that was a big moment for me, that I realized that you need some sort of a systematic way to enter and exit stocks, even if it's an investing portfolio, there needs to be an objective metric which tells you. And mind you, even if it was a winning stock which ultimately went on to make profits, if it fell to 10%, I sort of assumed that I'd exited it. So this is not that only on the losers I put a 10% stop loss and I remove the loss. Even if a stock ultimately turned out to be a loser, I still put that 10%. Ultimately turned out to be a winner, I still put that 10%. And but still the overall portfolio basis returns so much higher. So that tells me that basically what we need to view stocks as are like a call option. And between 2010 and 2015, then my returns post 2013 just made up for all of that. The underperformance that I thought I was showing in my personal portfolio. So this is basically what what I was trying to convey through that slide. That it is basically that any long investment is basically like a call option with a predetermined exit price. And as we'll see later in the talk also, that there is a behavioral bias among investors, among human beings, that we tend to take our winners, we tend to sell our winners really fast, and we tend to hold on to our losers far longer than we are supposed to be. And that creates the difference between making fixed deposit returns, average returns, and outstanding returns, or returns beyond the benchmark. So basically, the bottom line here is that profits take care of themselves, losses don't. So if you have, and ultimately as investors, we are risk managers. We can manage the downside, we can manage the risk that we take. We cannot manage the upside. The upside is what the market gives us. Now, we looked at another important study along the way, that over the long run, what percentage of stocks account for all the gains in the market. And if you guys have, if somebody wants to just take a stab at this, you can just put it in the chat box, and I'll try and see how many of you get that right. But what we saw that and this was in line with with global studies. Okay, somebody says 20%, 20%. Yeah, you guys, somebody saying 33%. So Anand is closest to the answer. That says about 2%. So what we found was that about 20% of stocks accounted for all the gains in the stock market. We did this for a 10-year period. We looked at the 2006 to 2016 period, and even the original paper, which looked at the US stocks, also came to a similar proportion, that 20% of stocks will account for all the gains in the stock market. So that means 80% of the stocks are ultimately going to give you a return of zero. So what should we be focusing on? Should we be trying bottoms up to try and pick those 20% winners, or should we focus on trying to avoid and weeding out all the stocks that we think would be losers in the long run, and by process of elimination end up with a portfolio of winners? And I think this was also a big reason for me to take up. When I saw this thing, I thought, it just makes sense to focus on weeding out stuff that I don't want to buy, and rather than just trying to focus on which ones to buy. So, and this is what Charlie Munger said when he said that invert always invert, and he said, let me know when I'm going to die, and I will never go there. So if we knew which stocks, or if we knew broadly, which stocks are going to underperform or show characteristics of underperformance, we know that those stocks are not to be held, or if we import them, we should be exiting them pretty fast. So people from whom I learned along the way in the last 10 years, the people like Jim Anish,
sorry to.
Yeah.
Anish, you are assuming that all of us are conversant with all the terminology, but however, some of us are like beginners. If you can explain about invert, it might help. Sorry for the.
Which one? No,
you said invert, always invert. So I just want to understand what do you mean.
So when he says invert, So when as investors, we look for, when we're doing a bottoms up approach, we are saying that let's try and pick the stock that is going to outperform. Okay. When I invert that question, Srinath, I'm saying which are the stocks that I don't want to buy.
Okay.
Right. So which are the stocks I don't want to buy? So that is what Charlie Munger meant when he said, let me invert the question. Let me invert what question I'm asking myself.
Okay. Okay.
So basically he said, and he elaborated on that by saying, let me know where I'm going to die and I will never go there. So he's saying that, if I know that this thing is risky for me, or this is something that is going to be not suitable for me, I'm not going to go there.
Okay. Okay.
That's
Thank you.
Yeah.
Thank you.
Please feel free to ask questions right in the beginning. Just stop me and ask questions. No worries. So like I said, these are the couple of books that I liked, really Stocks on the Move and Quantitative Momentum. And of course, the original paper on Momentum by Jagdish and Sheridan Pittman. Very, very seminal paper in this business. And on trading psychology, I like these two books, which sort of put you in the framework of how to, because there is a behavioral component to this also. We as humans, while it may look that it's easy to follow a system, and when I show you the simple system that I've put together today, you might think it's too simple, but it's not so easy to follow that system day in, day out if you don't have the conviction, if you've not done the work and you've not built conviction into this. This is what Richard Feynman said famously, that we have that execution is everything. So in quantitative investing also, and in all kind of investing, you can have thousands of ideas, you can have lots of analysis, but ultimately it all boils down to, can you execute your plan when things go, like a March 2020 situation comes along, and you may have a plan, but are you going to execute that plan? And that makes all the difference. So in 2000, all these findings and all these insights I used to share with my friends, and then they used to come and tell me that, would you like to manage our money, because we understand what you're doing, but we sort of don't have the time to do it, or it's a full-time job. So would you do that? And that's how QED Capital was born. So we registered in 2016. I continued using the same investing system that I was using for myself, and of course we've evolved a lot along in the last 4 or 5 years. But broadly, the philosophy remains the same. We run 2 strategies. One is a equity stock portfolio, which is run on momentum principle, which I'll show you as we go along. And one is an asset allocation portfolio, where by asset allocation, what I mean is we are not picking stocks in that portfolio. We are allocating to equity or debt or gold and building a portfolio, customized portfolio for people to map it to your goal that that you may want to do. Now with that, let's jump into something that we learn, and we all learn. It's taught in business schools all around the world, that markets are efficient. Markets are, asset prices reflect all available information. There is no way for you to do better than the market over the long run. However, we've seen that there are investors who manage to outperform consistently, and whether there's a George Soros, or there's Warren Buffett, or whether there's and even others like, say, a Monish Pabrai, or even in India, the individual investors, they do have a style, and there is a way to for people to outperform if you are able to stick to your investing philosophy over the long run and execute, and that's a very important thing. However, the problem with the efficient market hypothesis stems from the fact that if the market is efficient, who is keeping it efficient? Because ultimately, if you're a passive investor and you are buying index funds, and index funds are a great way to invest, but you are not taking a call on pricing. Somebody else is doing that, and those are the active investors who say that Infosys delivered a warning on earnings, or Sun Pharma has come out with some bad news on FDA approval, or something else has happened. Somebody is taking that call and trading or investing and factoring that information into the price. And that is done by active investors. So this is what the Grossman-Stiglitz paradox tells us, that if asset prices perfectly reflected all information, nobody would do all this analysis and nobody would go in there and trade assets. And if they didn't do that, asset prices could not reflect information perfectly. So when Eugene Fama and Kenneth French, they talked about markets being efficient and all the academics, what they meant is the market is frequently efficient, but it is not always efficient. And the compensation that active investors earn is very tough. It's not easy that, fine, we know that we may still understand that the market is inefficient and there is an opportunity for us to make money. But that does not mean that it is easy to make that money. There is a lot of pain that you will go through. It may be a pain of underperformance sometimes. It may be the pain of drawdowns. It may be the pain of losses. It may be that the market is going up and your stocks are now, your particular strategy is not doing well at that point in time. So there are all different kinds of pain that you will have to undertake to on that premium, and comes at a cost. These are some of the reasons why inefficiencies exist in markets. I spoke about the disposition effect, that people tend to sell their winners first and hold on to their losers, which is the exact opposite of what we should be doing. We should be holding on to our winners and cutting our losers short. Otherwise, you're doing the opposite of what we saw in that call option slide, that you are not cutting off the left tail of your probability distribution. We learned that nice normal curve. Well, of course, markets are not, returns are not normally distributed. They have sort of fat tails, but that model works on an approximate basis. That you should not take it as totality, but on an approximate basis, the model the Henry the normal distribution model definitely works. Then a couple of others, you may be familiar with some of these from your behavioral finance classes, anchoring bias, confirmation bias. The lottery effect again is very interesting, that investors tend to chase stocks which are moving up a lot in the near past. And when I say moving up, I'd be moving up 10, 15, 20% in a day, and those are the kind of stocks that people get attracted to. But those are not pure momentum stocks. Momentum, moving up 5, 10, 15, 20% in a week or something of that sort is not a good momentum stock. It tends to be a good lottery stock. And what happens at the odds of that, because investors cannot leverage, retail investors or other institutions, they cannot take leverage to invest in the market. So what they do is they take beta, which is the volatility. So they pick on high volatility stocks and try to do a proxy leverage through that, and say, if I have 100 rupees, then I will try and buy a stock which is moving up a lot in the recent past, because I think that, okay, if I buy something at 15 or 20, and if it's moving up 20, 30% every day, there's a good chance that will become 50. Whereas if the stock is compounding slowly, people don't want that kind of a stock. So, but those are typically good momentum stocks. HDFC Bank is a good momentum stock. Now again, one more inefficient reason that causes inefficiency, and we see this in practice in the market. If you can see the slide ruler on the left hand side, you can see that's the valuation, and you can see that the green portion on the top side shows when the market is undervalued, the yellow is when the market is neutral, and red is when the market is overvalued. And below that, we have the inflows in the market. And you will see that only 2% of the money comes into the market when it is undervalued or it is the right time to invest. Whereas almost 75% of the market, 75% of the inflows come into the market when the market is overvalued. And even studies in US and India now, and even India now, is showing this fact that investors tend to underperform even the market return, like even in index fund, because of timing their entries and exits in their long-term portfolio. They tend to do that at the wrong time. This happens because of various reasons. Sometimes we invest without a plan. We have no idea of what we're doing, or we think that, okay, I'm just buying this mutual fund, let me see how it goes. 2 years later, if it's underperforming, we'll try and switch to something else, which is there. And so trying to get in and get out, and you can see how that chart on the left hand side shows that when they try and switch, that time to switch is not usually the best time for investors to exit. So you can see this part. This is when you should be coming in, but you can see most of the time people are coming in when the market is overvalued. So this is what I was talking about. The market being efficient. That frequently efficient is not equal to always efficient. And there's a big difference between these two propositions. That if the market was always efficient, there would be no way that any investor would ever outperform the market. But if they are frequently efficient, it ensures that there are times when people can come in and, or if they have a particular style of investing, those styles can be expressed and you can earn a premium over the market. So this brings us, to our topic for the day, which is factor investing. And factors are nothing, not very complicated or not, something esoteric. They are basically, we have seen this, and we also, most of us also follow this in our investing style. Is that we look at either we tend to buy value stocks which are cheap, or we saying, okay, no, we're going to buy a quality company like say a Nestle or an HUL or an Infosys, or somebody says, no, I'm going to buy stocks that are moving up and try, or I'm going to look at all these three parameters and see which ones meet all of that. So that is called the active. Most active investors follow that path and move and build a portfolio from bottoms up. Passive investors on the absolute other side are people saying that, look, I know that perhaps somebody full time may be able to beat the market, but I'm okay with what the market gives me. I'm okay investing in an index fund, and that gives me a good enough return, and I'm able to beat 80% of professional investors in the market. So I'm okay taking an index fund. What factor investing does is it's a quasi passive or a quasi active strategy. It falls somewhere in the middle, which is why it's also sometimes called active beta. Beta being the market return, and active comes from active investing. It's also called smart beta. Those are all similar terms. So when we are using factor investing, we are using the characteristics of index. That is, it is a rule-based investing strategy. The index is not a passive or always constant portfolio. It's an organic portfolio in which stocks that are doing well and fulfill a certain criteria are included in the index, and stocks that are not doing too well or stop fulfilling a certain criteria are removed from the index. That is done in a very rule-based manner. The rules are all out there. The Nifty or the Sensex index committees put out the rules, and we can see that these are the rules through which they are going to enter and exit stocks in the index. So that's the part we take from the passive side, and from the active side, what we do is we are basically taking a portfolio of stocks and slowly tilting that towards a particular factor. So yeah, so this is what what I was talking about, that passive investors typically focus on asset allocation, whereas active investing, they're looking at bottoms up security selection. We're picking active stocks, and factor investing sort of tries to take the best of both, and you can implement these on a systematic manner. You don't have to worry about which sector is going to do well, which stock is going to do well, or how am I going to exit the stock. So, and that's the alpha that is left today in this market, that the information arbitrage to a large extent is gone, and the only arbitrage that is left today is behavioral arbitrage. And the losers game, why we call it, Charles Ellis calls it the losers game, because he compares it to a game of amateur tennis, where in amateur tennis the points are lost by the opponent, whereas in professional tennis points are won by the player. Whereas if you're playing amateur tennis, if you just hang in there and wait for the other guy to make a mistake, you're going to win. So that's why he calls it the losers game, how to win the losers game. And even Warren Buffett has kind things to say about passive investing, saying that when uh, passive investors or know nothing investors know the limits of their circle of competence, they tend to become smart money. It's not, you can't call them dumb money anymore, because they know their limits and they know that this is how they're going to invest. And just by investing in the index, you're able to beat almost, like I said, 80% of active investors. So which are the factors, which are the uh, most commonly used factors which have been found to work in practice as well as in academia? We probably, if you look at research papers, you'll find almost 300 factors that have been discovered, but they don't always stand the test of robustness and implementation. These 4 or 5 factors: momentum, low volatility, value, size, and quality, which are defined, as you can see on the slide. These factors have been found to work over time in out of sample tests, in sample data, as well as are robust across countries, across asset classes, and the premium persists over a period of time. It's not that you publish something about this and these returns are arbitraged. They are not arbitraged away so easily. Mainly because human behavior cannot be arbitraged beyond the point. So a couple of reasons why factors work. One, I spoke about the behavioral error, and either it's a risk premium. For value, the risk premium argument seems to be more stronger. That when you're buying a stock with cheap valuation, there is something that is going on with the company, there tends to be bad news around that situation, and that's you're buying the risk of buying that stock is fairly high. So you are earning a risk premium in buying a cheap stock or a value stock. There are even behavioral reasons attributed to value. For momentum, I will come to that in the next slide. See that why does momentum work? But before that, let's just look at the evidence from global markets and look at some numbers. And you guys can just go through these numbers. Market beta is nothing but the returns that you would get from investing in an index fund. So if you just did nothing, you would get about 8.3% over a very, very long period, over a 100-year period. It's been tested and found to work. Momentum, on the other hand, comes with slightly lower volatility and with much higher returns than the other 2 factors, size and value. And these kind of funds are not small in the US anymore, and even in India they are they are there, but they're still small in India. Maybe I would say 3,000-4,000 crores, not very large, but that will also grow over a period of time. Momentum funds, low volatility funds, combined multi-factor funds, they're all being launched as we speak. And ICICI and UTI have both launched momentum funds and low volatility funds. So those are growing in India as we speak, and in the US and globally they already have about 900 billion to $1 trillion invested in these kind of strategies. They tend to be much lower cost than than an active mutual fund. Now, the smart folks at AQR also did a study of Warren Buffett's investing philosophy, and what they came up with was very interesting. That we all know that Warren Buffett also has a lot of insurance float, which he uses to invest in the market, and his insurance float actually acts as leverage. So what Buffett does is that he buys these low volatility safe companies, like from the likes of Coke to Wells Fargo, Johnson and Johnson, Procter. He bought all these companies in the past, and now he's bought Apple as a consumer play. But his main intention is to buy these stocks that have established themselves, where very little is going to change in the future, and the cash flows are relatively stable over a long period of time, and leverage it. What the paper found is that the insurance float that Warren Buffett uses applies a leverage of 1.6 times. So it's not that his genius comes. His genius comes from the fact that he figured this out long before a lot of academics figured this out. Second, he was able to implement it because even though we know that this is what he does, does not mean we are able to implement it ourselves. He's seen in his lifetime, he's seen a drawdown of over 50% 3 times, and that's not, and on a very, very large portfolio. That's not easy to stomach. But at least today, we look a lot at his stock picks. We try to see how he's analyzing companies, but very few people have studied how he constructs his portfolios, and that is not emphasized enough. And so that's an interesting paper. If you guys want to read that paper, you can just Google that, and you will get that paper by EQR. Now, Eugene Fama in general does not accept momentum as a factor. Because it sort of is in conflict with the efficient market hypothesis. But over the last 5-6 years, they've come to terms with that, and they said it's a premier anomaly. I think that's as far as he will go. But interestingly, Eugene Fama co-founded a fund management house with his student David Booth, and they run over $600 billion, and they have said that they use the momentum factor when they are buying and selling stocks. So in practice, I think that's a statement that Pharma is making, that yes, if momentum is there, I have to use it. I cannot wish it away. It's like gravity, or it's like, why does the Earth go around the sun? I don't have an answer right now, but the fact that it goes around the sun is something that I cannot ignore. If I'm doing any calculations in astronomy or something of that sort, I cannot just say that this is my construct and this is how it's going to work. You have to look at the empirical data that is out there and be practical about it. So Dimensional uses momentum, and it's on their website. They said it in lots of podcasts and interviews that the momentum premium does exist. So with that, let's get into what is the momentum factor. And again, it's a very simple definition, that it's a tendency that if a stock has done well in the last 3 to 12 months, that's a medium period. Stocks that have continued to do well in the last 3 to 12 months will continue to do well in the next medium term, the next 3 to maybe 1 to 6 months. Maybe after that, the premium sort of starts to fall off. So typically, monthly rebalancing, you need to sort of update your portfolios on a monthly basis. You need to do the ranking. We need to do that ranking, and that's how we sort of rebalance the portfolio. Now, so that's as simple. That's as much as you get about momentum. That's what it is. So the behavioral reason why momentum seems to work is that there are all kinds of participants in the market. Everybody from a day trader who has a one-day horizon to a high-frequency trader who has a nanosecond holding period, to an endowment fund which has decades. Now, all these people factor in information in their own time frame, and that's why it takes time. Information gets factored in over a period of time. It diffuses and gets factored in over a period of time. And sometimes, even when that same information comes over and over again, and again, I take this example of HDFC Bank, returning 15-20% quarter on quarter, year on year. People just tend to ignore that, or say, oh, it's again HDFC Bank has come out with 15-20% return. But it is very, very consistent, and investors tend to they don't factor in that part very, very quickly, versus they're trying to go in for something that's moving fast, or that's something that will give them quick return. But they take their time, and everything does not get factored in the moment it gets out there in the market. The risk-based explanation is there also for momentum stocks, but it's to do with that if stocks go up, the expectations from them also go up, and they face a greater discount rate. So, but the behavioral reason for momentum seems to be much more robust, and most practitioners as well as academics are more in agreement on that explanation rather than the risk-based explanation. Now, coming to what we are going to do today. Typically, when I showed you that slide on momentum premium or on factor premium, when academics tell you that there is a premium in momentum, or there is a premium in buying value stocks, what they are doing is they're constructing a long and a short portfolio. So they are saying, okay, I'm going to buy the top 20 or the top 30% cheapest stocks, and I'm going to go short the most expensive stocks, because that's how I will know that that there is a premium for buying value stocks. So typically the cheapest stocks should outperform, and the most expensive stocks should underperform for that premium to be present. And for momentum, it's that stocks which are outperforming in the last 3 to 6 months, they buy that top 20% or top 30%, and they short. Then they say that we're going short the bottom 20%, and those should typically underperform the top 20 to 30%. So they look at the spread. They look at the returns of the top 20% minus the bottom 20%. But now it's not practical for many. Not in India, we have our own issues about shorting. We don't have only certain stocks are available in the futures and options segment. In a lot of other stocks, they are not very liquid, so you may not get an opportunity to short. So we tend to look at more, more at the long side. That if I were to just buy the top performing stocks, is it going to do better than the market? We focus on that question, and that's the question that we ask ourselves while doing this research. And so there is that exists. This is being found by Professor Verma and his colleagues at IIM Ahmedabad, and they maintain a database similar to what Pharma and French maintain for the global market. They've maintained this from 1994 to 2019 for the Indian market. And the surprising part again, but ties in with global, there is no premium in buying small caps. That goes on a lot in the market. That there is alpha to be made in small caps, but data does not sort of tend to support that thesis. Momentum again has worked pretty well in India also, and they published this paper in 2014. So we broke up the period between in sample and out sample, and then we looked at the performance out of sample also, and seen that whether it holds up or not. But here what we're doing is we're looking at only on the next few slides, we're going to look at only the long only portfolio. What happens when we just buy the top performance? Because we are not going to look at shorting. So does buying the top performers, does it have a premium, and are we able to outperform the market on that? So this is the question that we ask. What I just said. Does a simple long only strategy work on Indian stocks, and do you earn a premium over the Nifty? And this is how we do it. That I just in a couple of minutes I'll share a sheet with you guys. So if you guys have a laptop, or if you have something like that, you can download the sheet, and I'll take you through that and take you through a couple of months of data, and show you how that effect works. If you don't have it, we'll just do it here, and then at your own you can play around with the sheet. It's fairly intuitive. It's not rocket science. So this is what the steps that were followed in most global studies and Indian studies that are done on momentum. You look at a returns of the universe based on the last say 3 to 12 months. We've taken 6 months, which is the midpoint. We buy the top ranking stocks. In our case, we've taken 20 stocks, what I'm going to show you today, and then we hold them for a month. And at the first of the next month, when we do a ranking again, and we see which stocks have remained in the top rank, we keep those stocks, and stocks which have fallen out of the top ranks are replaced by stocks which have entered the top rank. So is that part clear, or you want me to explain this before we get into the Excel sheet? Just let me know. So winner big is basically looking at the top, the large cap stocks, and so the paper for India as well as the global paper, they divided into they sort of carved out the momentum portfolio into two parts, just to see that was there a size premium effect in is there premium in large cap stocks, is there a premium in small cap stocks, or is it that the size effect is driving the returns? And they found that there is momentum both in large caps as well as small caps. So we've taken winner big, which is what are large caps, and Nifty, they've come out with a number of strategy indices on which mutual funds have launched the smart beta fund, and we sort of taken the Nifty 200 momentum 30 as a proxy, just to see, because the database maintained by Professor Verma stopped in 2019, so we wanted to extend this test by another 2 years. So this is what we found. We found that there is a premium that exists, and this premium has sort of widened in the last 10 years also. That in the 2005 to 2014 period, the market gave a return of around 16%. The winner big portfolio gave a return of around almost 19%, and the Nifty Momentum 30 index gave a return of 20%. What's interesting is if you look at the last 2014 to 19 period, while market returns dropped to 12%, both the momentum indices continued to show that 20%, 19 to 20% return. So the spread between the market and the momentum index actually went up in the post publishing period. What happens, although, is that sometimes it comes with higher volatility. So we looked at another factor, which is the low volatility anomaly. But I'm not going to go through that today because we are sort of short on time and mindful of that. So I will share this with you. You guys can go at your own pace. So we added volatility to this to measure the quality of momentum, and that's a strategy. That's a model that we use in-house called Q-Mor, or quality of momentum. So the basic intuition behind this is that a low volatile momentum stock will give you much better and higher returns than high volatile stocks, and you can contain drawdowns and volatility with that. And that's what we broadly found, that and we've been running this portfolio live as a part of our stock portfolio, and we found our returns to be in line, and our experience has been sort of similar to this, that we see a lower drawdown. It comes with slightly higher turnover, but the drawdowns are much lower, and incidentally the returns, the higher the returns, even if they are as much as we get in a momentum portfolio, that is the momentum 30, even if we get like 20 to 23%, that's good enough with a lower drawdown. These are the rolling returns. Again, these will be there in the paper that we'll share with you post. So yeah, so putting all this into practice when the rubber hits the road, that's the most important thing. And this is usually what a system. I'm just giving you the breakup of how a system works. You have a universe, you have an entry exit signal. You have to decide what to buy, how much to buy, how to manage that portfolio post buying, and when to exit, and how to rebalance that portfolio. So what we are going to do, I'm just going to close this for a moment. And I'm going to share a video with you guys while I'll also send across the file to you, the file to you, and you can just listen to David Harding, who runs a $20 billion quant trend following fund in the US, and you see that usually when we're running quantitative strategies, we are completely relying on our system. We put all the discretion and everything that we have to do, we put it in the system. We don't sort of interfere when we are executing, and we try not to have opinions about the market, or at least even if we have opinions, we do not try and impose them while making investing decisions. Let me just pause it for a moment. Let me first, there's this 1 minute video where Jim Simon comes and talks. So let's hear what he has to say. Let me just see the order. One second.
But your firm.
And
You're not running the firm anymore,
even
right?
if I were, I wouldn't have any opinions. The computer has its opinions, and we slavishly follow them.
That's just the part I wanted you guys to hear. And then there's another one, which is another 2-minute clip, which is probably something that you guys will enjoy.
It's based of 50 years data on all the world's financial markets, all the stocks and the bonds and all the financials about them and so on and so forth, and all the futures markets. And our scientists, we have 120 scientists, and their job is to look back into that database and ask questions like, if we'd done this in the past, would it have worked? And thereby devise a big computer program called the Winton system that is like a very elaborate plan for investing over the next 10 to 15 years, so you kind of know what you're going to do in all circumstances, and you don't have to respond every day emotionally to what's happening.
Does that give you a good enough blueprint that you could actually say, we think the price of gold is going to Z, or is it a little more complicated than that?
It doesn't give us any good guidance, sadly, about what's going to happen in any markets at all, ever. Our computer just doesn't give up. It just doesn't know when it's beat, basically. So it just goes on every day, flogging away at these things, none of which are good at forecasting markets. They just have a slight edge, like a 51% edge in a coin tossing contest.
Because history, doesn't repeat, it rhymes. So you need to you need to base your investments on something that might rhyme, not repeat, right?
Exactly. And you mustn't be blown off course by what's happening day to day. You have to have a long-term plan with investing.
Then you gotta let your losers run forever, though. That's what's scary. You can't. You cannot cut your losses short a lot of times, right?
Well, we have such a big portfolio, so diversified, that we really can let our losers run.
You can,
really not.
You got something else running.
If you've got a highly leveraged position, then you have to have a stop on and you have to get out. But we can really bury a lot of stuff.
Can you tell us any big, major macro things going on that the past has told us that we might not know about right now? Like
No, I can't. I can't.
Does the dollar lose its king dollar status eventually?
No, I mean, we have no knowledge or information from our computer systems like that. I can tell you what we're doing. This year we've been long stocks, short yen, short gold. And as is often the case, incidentally, we've lost loads of money on bonds and lots of money on commodities and so on and so forth, lest you think I'm giving you all the winning trades. You know. But we've made a bit more than we've lost overall, which is, kind of good, obviously.
Yeah.
Yeah. So now let me just try and send the file. I mean, is there any other way to share the file? Because I saw earlier there was a way to send the file from the chat, but I just can't see that option right.
Did you have a link to the file which you can share, not the file directly?
Yeah. Let's just send the link. Guys can if you want, you can download the file from here. And yeah, and have you guys got the files? And can you guys
see? The attendees, it is not directly connected, has not received the text in the chat. Can you please share? Or
sorry, you've not got the link?
No.
Anish, you have sent the link to me only by mistake, and
okay.
I tried opening it. It requires access. So can you please just make it open and share it to all the attendees?
Yeah. I've sent it again. I think it's shared with everybody. Is it working, Alan? Are you guys able to
Yeah,
download?
you had shared it with me only again. I shared it with everyone, and it's working. I just opened it. Yes, I believe everyone should be able to access it now.
Okay, awesome. So, all those who have a laptop and are sitting on the laptop, if you've just opened the Excel file, you can go to the April 2020 tab, and you can see here, that the stocks. You can just sort everything by. We put the filters on top. So just sort everything by the first column, which is the ticker column. Sort everything by A to in order of names. Right. And the second step would be then to go to column D, where we have the historical 6-month return. And in column E, we have the 1 month forward return. So if what was the return of the stock 1 month later to that. So if this is April 2020, then what was the we are sort of buying this portfolio on the 1st of April, and what are the returns for the month of April. Now, once you've sorted it by name, what we are going to do is sort it by column D and sort from largest to smallest. So basically, we are ranking it in terms of which stocks had the highest returns over the past 6 months, and which stocks, and as it goes down in descending order. As you can see now, in column G, you will see that the top 20 stocks returned average return of 5.4%. I've assumed equal weightage here to all stocks, without getting into things like volatility based, right? Vol based position sizing. Can you guys see my screen? I'm not sure if you can see this. Okay, I think it is not shared. Now you must be able to see it. I think you can see it visible. Yes. So I just went and sorted everything by column D, which is the 6-month historical return. And I've seen I've got the top 20 stocks, which you can see in G. You can just see it's the average of E to G21. And that's performed better than the index, right? The index in April 2020 gave you a return of minus 3.5, and the bottom 20 stocks gave a return of minus 5.7. Remember, this was just the month after the pandemic. Then I took another period, and I'll show you the whole year's return in the slide later, lest you think I just picking out the ones which work. But again, here you'll see that we sorted from largest to smallest by column D, and you'll see that the top 20 stocks have given a return of 4.3%. So we've done it very simply. We've taken all the stocks which are there in the futures and options segments. They are the most liquid part of the of the market. We've taken their 6-month historical returns, and we are just ranking it on the 6-month historical return, and then buying the top 20 stocks and taking an average of the returns. So you can see again in August, Nifty gave a return of minus 1.3%. The top 20 stocks return of 4.3, and the bottom 20 return 9.8, minus 9.8. So if you had a long short portfolio, you would have earned almost 15%, because 4.3 minus 9.8, that's almost like a 14%. Again, we see the same thing in January. You just sort everything by largest to smallest in column D. You will see that the top 20 stocks gave a return of 21%. The Nifty gave a return of 6.3%. So you earned a premium of almost 15% over the Nifty. And the bottom 20 stocks gave a return of 13%. And in May 2021, if you again go and sort everything by column D, which is largest to smallest, you'll see that the Nifty gave a return of 1.1%. The top 20 stocks gave a return of 1.6%. And the bottom 20 stocks at this time turned out to be better than the top 20 stocks. And that happens over a period of time as stocks go through some reversals, go through that. So not every month will be, but we're not, since we're more focused on the premium between the Nifty and going short the Nifty, going long the top 20 stocks. And this is a very basic, very, what do you call it? I mean, we've not applied anything to this. It was just taking the returns and so any questions on this sheet, guys? You can just type it or you can unmute yourself if you can. I can't see everybody's questions.
So, Anish, we can wait for a couple of seconds if anybody has questions on this sheet. Otherwise, I also have some pending questions from your talk, which I would like to put to you. So we'll just wait for questions on the sheet first.
Yeah. So if it's all done on the sheet, I'll just show you the the returns for the whole year. So you can see here that I'm calling it the T20 stocks and the Nifty 50. So over the year, you would have you can see the gap between the red line and the blue line. That's the premium that you want over just in this very generic strategy of just ranking the most liquid stocks. And you can see the period during COVID. If you were running a long short portfolio, you would have just had a minimal drawdown. But with the generic and the Nifty, you would have seen almost 30% drawdown. And of course, they all recovered and everything was good after that. But if you were just neutralizing out the market risk, you would have, with a very basic strategy. But yeah, would you have followed it during that time? That's the biggest question. So the different ways to improve this, and we can do that. Yeah, so we can move to Q&A now.
Sure, Anish. So I'll start with the first question which was asked. So the question is, DFA has recently launched ETF funds, which is passive strategy, for the first time due to a lot of outflow in traditional funds. Does that mean momentum lately is not doing that well as compared to passive index strategies?
You think Dimension has launched? Sorry.
I'll repeat it. So the question is, DFA has recently launched ETF funds.
Yeah.
When they saw a lot of outflows in the traditional funds. So the question is, does that mean momentum lately is not doing that well compared to passive index strategies?
Okay. So momentum is momentum is only one of the things that they use. So typically Dimensional is a fairly passive, they focus more on value, they focus more on all those other things. What they've done is they have launched ETFs, but they are earlier they used to sell only through advisors. Now they have, because of the inefficiency of taxation in mutual funds, they have converted the mutual funds to ETFs because the tax efficiency is higher. Now in the US, if you know that the fund, underlying mutual fund makes gains, those gains that even if they are not distributed, you have to pay tax on it. So it's a fairly inefficient structure for mutual funds in the US. So that's one of the reasons why they've sort of launched ETF. So it's nothing but just changing the structure of their fund. It's nothing to do with active passive not working or things like that.
Okay. We'll move on to the next question. What is the ideal duration for which one should look at performance for momentum? I think they are looking at they're asking about the look back period. You mentioned
Yeah.
6 months is what we take on average. Is there
Yeah.
a science behind it? How does one answer 6 is better or 3 is better or 9 is better?
Yeah. So there is so the data shows that in the short run, there is in the 1 month period there is a mean reversion. So stocks that have done well in the past 1 month may not do as well in the next 1 month, and stocks which have not done as well in the last 1 month may do well in the next month. So usually when we do this when we practically implement this, we skip the last previous 1 month. So what findings across various academics as well as implement practitioners have shown that 3 to 12 months is the window that typically one uses to see the look back period. Beyond that, returns tend to be mean reverting. And actually, if you are more into mean reverting kind of strategies, anything over 3 years, 4 years, 5 years, that's a fairly good look back period to look at for mean reversion strategy. Something that has been making lows for almost 5 years, and you want to, nobody's paying any attention to it. You want to buy something of that sort. That usually works in mean reversion. In momentum, anywhere between 3 to 12 months, and even holding period, it can be anywhere from 1 to 6. So the Momentum 30 fund that I mentioned, they balance on a quarterly basis, and some other funds are there which rebalance on a 6-monthly basis. In the outside period, I would say 6 months, and for rebalance. That does not mean that no stock will remain there for over a year or 2 years. There are some stocks that we, something like CDSL or something like CAMS or something. Some of those stocks have just been there for almost over a year and a half now for us. So it does not mean that those stocks, when you rebalance it on a monthly basis, that stocks will drop out. They won't drop out. They will, some stocks will just continue to go on and on and on.
Great. So there is one fair question. The question is, since you are churning stocks every month, the returns that you have shown, are they net of the transaction costs?
So now they don't, it doesn't make a big difference because long-term capital gains is 10% and short-term capital gains. So you can block off 5%. It's the same thing. It won't. But if you do it in the mutual fund wrapper again, like I mentioned, it may tend to be more efficient from the tax side. But because it's a fairly the early days in these factor strategies in India, you can do it in a PMS wrapper or in a some other do it yourself for a kind of situation with lower drawdowns, with higher returns, with a more concentrated portfolio, and the post tax will be comparable to anything else, because earlier, yes, when when there was no capital gains tax on long term, there was there. But even with that, I think you would tend to make more money. But yeah, you would not take this as, unless you're doing it full time or implementing yourself, this would not be a core portfolio. Would typically be a index fund and passive fund. This can be like a satellite portfolio that you're using to outperform in your portfolio.
So we'll take 2 more questions. Yeah. First question is, do you use any technical indicators such as RSI?
No, we don't use it. We just use price and volume.
Okay. Second question is, and I'm taking this up because I think there are a couple of people asking this, that what is the weight allocation to the top 20 and the bottom 20? So the question is, what is the weight allocation between top 20 and bottom 20 and within the 20 stocks? So I think first we need to clarify it's not a long short portfolio and then the individual allocation among the long stocks.
So for this sheet, like I mentioned, I have taken just an equal weighted. So I've just taken a simple average. But there are different ways to position size, and I found that if you take volatility-based pricing, volatility-based position pricing, which is what we use in practice. That is a highly volatile stock. So let's assume you got 20 stocks. Now you look at the standard deviation of those stocks again on a 6-month basis, and the stock which is the least volatile gets a higher allocation, and the stock which is the most volatile among the 20 gets a lower allocation. So let's say Bajaj Finance, Yes Bank, and HDFC Bank, all three were to come into your portfolio. HDFC would tend to get the highest allocation based on risk and volatility, and Yes Bank would probably get the lowest, and Bajaj Finance would be somewhere in the middle. So we are not, and the bottom 20 is also here just for demonstration purposes. I've just just to show it, I've taken an equal weight, but stocks that are going down are usually volatile. So you have to weigh them differently. So you have to make the betas the same. So you have to do some adjusting there. Here, because we're just doing a quick overall view just to show the concept, I've just taken it on average. But even if you take that, it's still showing a premium over over the last 1 year as well.
Great. Thank you so much, Anish. We are at the end of our webinar/workshop, and I would like to thank Anish for taking out the time and making us go through factor investing. I hope it was useful to all those who joined. We'll keep organizing such webinars as we have been doing in the recent past. And I would just like to sign off by first saying this is not investment advice from NSAI's trading lab. And I think
from our side also, it's just research that we're sharing with you, and our findings that we're sharing with you, because we are passionate about quant investing. And like I said, we are going to send out the paper. We've come out with a paper on momentum investing, most of the findings that I discussed in the presentation. So just drop in a line to, either you can go to factorinvestor.substack.com and subscribe there, or just send us a one-line mail saying, can you send us the quant, the momentum report. It should be ready by next week. So you can email us at info@qedcap.com and we will send it to you, but not investment advice, or not just sharing research with you guys.
Thank you so much, Anish. And thank you all for joining in. And we'll keep you posted on our upcoming webinar. Should happen, let's say.
Thanks, Anand, for organizing this. It was very nice.
Our absolute pleasure to host you, Anish.
Thanks. Thanks a lot.
Thank you, everyone, for joining.
Thanks to everyone who came. Thanks, guys.
AV, you can stop recording.
Okay.